Just wanting to confirm before we get started that you can see and hear correctly, and then we can get moving. I do appreciate that everyone's taking the time out of their evening, 7 o'clock. Hopefully the kids are in bed. We're getting ready to dive into some property investment. Colin can see all good here. Thank you, Colin. Um, if you have any audio or visual issues, just let me know. There is a chat bar over on the right-hand side, and I can determine whether it's isolated or it's a wider spread issue and help diagnose. So it'd be lovely if you could just jump over into the chat bar and let us know that you can see and hear correctly. Thank you, Roseanne. That's wonderful. It'd be lovely to hear where you're all calling in from tonight. Richard, Casey, Burris, how are you? And thank you for letting us know. Look, I am really conscious of time and how valuable our time is, and especially on a week night. Lots of you are joining in from the mainland. Us Tasmanians are funny with how they say this, but it's Roseanne from the Sunshine Coast. You lucky person there, Roseanne, with the warm. Colin's in Brisbane, Linda's in Sydney, Richard's in Balcombe Hills, Steve's in Dawesville, Mandurah, Perth. Beautiful. Omar from Sydney, Casey from Johannesburg. Wow, awesome. Duncan from north of Cairns, Nikhil from Dubai, all across the globe. Amazing. Nishnant from Sydney, how are you? Simon from Brisbane, Frank from Brisbane. Lots of you coming in, and I'll catch those up in a moment. Once again, there will be a recording of this session sent across. If there are any questions related to what I'm going through, if it's relevant to the slide or what I'm actually speaking about, I will stop and talk through it. If it's more general in nature, I'll be holding it over for your Q&A towards the end of this evening. And there's an Ask Me Anything there. We're seeing a lot on the ground. We're seeing a lot in active negotiations. We're seeing a lot of, opportunities and threats emerging. So it's great to sort of go through those in as much detail as we would like. I'm here. I'm at your service. Look, the content tonight is probably about 35 or 40 minutes, and then jumping into that Q&A. So get the bottle of red ready and we can dive right in. So this is not a hype session. It's not a suburb tip hotline or a promise of guaranteed growth. It is a 45-minute decision framework for people who are serious about buying investment property without being led by fear, what's hot, or sales pressure. We know what's been going on this year with the budget. So by the end of this session, I would love it if I can help those on the line to think about property selection slightly differently, and whether a professional advisory process is right for you or your family, but really wanted to focus on that decision framework, because I see a lot of people using emotions when purchasing property. And if I can really help to break free of that and see the decision framework that we use, hopefully that will provide you a lot of value to take away from tonight. Once again, ask me anything, Q&A as the session's over. I'll jump right in. Now, I'm going to give you the logic, the framework, and the red flags. I'm not going to pretend you can recreate years of data, sourcing, due diligence, and negotiation systems, but I will take you through the how. And that is also what our team executes with clients, but it is also how you can do it as well. So I've got a couple of polls for this evening, which are really useful for us to understand a little bit of context. And I will be very, dynamic with how I can adapt and change the content tonight based on how you answer these polls. So it's really useful for me to understand where our heads are at. So do take the time to just jump in. They are very quick, so I can get a feel for things and once again update and adapt the content. So when are you realistically hoping to purchase next? Right, so about 1/3, 0 to 3 months, about 1/4, 3 to 6 months. They are changing on the fly. So it's about a 30% 0 3 months, 30% 3 to 6 months, 10% 6 to 12 months, and about 25% just researching. So that's an awesome mix, guys. Hopefully for those just researching, we can give some depth of knowledge and some, I call it like a decision framework that we can place for the 0 to 3 months looking to buy right now. Hopefully we can get some actionable advice and information out there for you. So look, let's take the time to read this aloud because it is really important, and I feel very timely in 2026 that exceptional investment outcomes don't come from finding more properties. We don't want more noise. They come from eliminating almost all of the properties that we would consider before we would even let ourselves get excited about the few properties that do survive. So let's let that sink in for a moment. Now, a few of you on the line are definitely familiar names, so hello to all of you. And there might be some of you on the line that are not aware of myself or my background. So if you would allow me to go into a little bit of details about myself, if you will indulge, I promise I'll only talk about the relevant property stuff, but it will be useful for context. So I purchased my first investment property in the early 2000s down here in Hobart. I went on to buy a few properties quite quickly and then moved to Sydney. My wife and I moved to the Big Smoke, and I guess you would say I pretty quickly lost my confidence. And I would say, categorize it as a case of analysis paralysis, which is something that we might have all felt at one point or another. And along with some friends that I'd met in the property investment space, we were looking at areas of Western Sydney. This is going back many years ago, places like Mount Druitt. I'm sitting there on the internet during the week, looking at properties, getting all excited. Those ones for sale on the market. There was one in particular that was on a cul-de-sac. It was a great street and it was at a really good price. And I thought, well, look, this is good enough. I'm going to go and check this one out. It's standing out to me. I went out to that property on the Saturday, went into the property, and there was literally a path worn in the grass alongside the house. People were using this property as a thoroughfare because it was at the end of a cul-de-sac to walk between the local public housing compound and the train station. They'd literally worn a path in the grass, knocked the back fence down. Look, I hadn't seen anything like this before, this type of property, the way that they were using this as a thoroughfare, the suburb makeup, having concentrations of housing, having cul-de-sacs, having train stations. I've come from a small place like Hobart, probably a little bit more decentralized, and I lost my confidence. It took Anna and I another 2 years before we purchased again. Right? We used to go out and go to a cafe every Saturday for brekkie. For lunch, we'd go to another suburb. For dinner, we might even go to another suburb. We did that because we would learn why people lived where they did, in all of the little nooks and crannies across Sydney and wider New South Wales, why they paid what they paid, and why potentially these places are going to grow in value. So that was the point that I started developing a framework. Ripehouse, this was even before Ripehouse. Ripehouse I began in 2011, but this framework got started even before then because I've got an analytical background, software engineering, AI, research, data. That's what I do and did professionally, back when I was working in the Big Smoke. And I used this to solve my own problems with property and research. So it took us 2 years to purchase again. We did. We broke through. We continued to purchase many more times across Australia. And now looking back after purchasing my first investment property almost 25 years ago, it has done wonderful things for Anna and I and our family. We've made a lot of mistakes. This is about avoiding those mistakes and, learning from them. We don't need to repeat them. And that's hopefully some of the framework that we can look through tonight. The hardest properties to avoid are not the obviously terrible ones. They are the almost good ones. The clean brick house with the nice agent, the plausible rental estimate, the suburb that a few people are talking about at barbecues. It's coming up every now and then. It's looking really good, but it could be something still wrong with that behind the scenes. We're not lazy people. Australians, we get up and go, but we do feel a little bit overloaded in this current environment. The market's giving us more inputs, more data, more AI, more noise, and the problem is no longer information. What we need more of is clarity, and clarity to make decisions, to take action, to turn messy information into a decision that you can defend now and in 10 years' time. That's what we're looking at doing. So I've got another quick poll there. That was really interesting, guys, and it's interesting to see the mix of those of you that are looking to buy now and also at the other end of the spectrum, not looking at purchasing anyway. But we're all looking at, leveling up in the way that we would consider property and property investment. So it's to be commended. So the next poll is another really quick one. Let me just bring that up here. I find it difficult doing two things at once. All right. What is the hardest concept in property investment that you are dealing with right now? So a few options: choosing a market, choosing property, due diligence and risk. And that probably moves more into confidence, finding time and confidence to act. So probably let's separate those out. What to do in due diligence and risk, and then applying all of this to build that confidence. So as that sort of comes in, I'll just skip ahead a little bit and we'll come back and we'll reassess those answers and see the breakdown for us all. It's interesting for us all to share. Now, each one of these elements here on the screen do contain useful inputs in isolation. But if you treat any one of them as a whole process, you live and die by a suburb hotspot or a deal offered to you by an agent or a particular algorithm or tool or growth guarantees, builder guarantees. If you treat any one of them as job done, whole process, then you may be exposed. It's not that they're wrong, they're just incomplete. And they do need to be combined with a wider decision framework. The right property is not the goal. And I don't want to sound corny here, but it really does live and breathe for me at the back end of an investment portfolio. The life that property investment does make possible is the reason why we're doing all of this. Let me jump over now to the responses from the poll. 25% of you, it was actually pretty even across the board, actually. Probably a few more of you looking at choosing property and choosing the markets as what is hardest for you right now. But then DD and risk, finding time, confidence to act were probably all tied for second. So yeah, it's an interesting mix. Choosing markets, choosing property, probably the standouts. And then interestingly enough, though, less than 1/5 of you, about 1/6, 1/7 of you didn't have confidence to act, which in this environment, it's commending you once again. There is a lot of opportunity out there. Have seen the top end of the market very cold and not performing very well, but the lower end of the market, sub $750,000, is extremely buoyant at the moment, and not just with tight, scarcity-driven buyer demand, also extremely strong and bullish rental growth, which is a very positive thing for me. Just got a few comments. Shannon's mentioned that the streaming connection is really bad, so we'll have to wait for the recording to come through. Shannon, is that isolated to you? Anyone else having issues with the connection? I'll wait for that to come through. No issues here. Mine's all good, Nigel. It might just be your connection there, Shannon. Yes, the recording can come through. Everyone else seems to be okay with the connection, so it might be localized. Might be the kids on Netflix. Who knows? Beautiful. I'll keep going. Now, the biggest risk that I see right now is purchasing a property when there is a little uncertainty in the market. We don't want to be buying the wrong asset confidently. Missing a good deal, it hurts for a week, hurts for a little while we're still sort of tossing over the lost opportunity, but owning the wrong property can hurt for years. The market rewards patience less visibly than it punishes poor selection. Have a think about that for a moment, because it does really ring true for me. Data gives us more sightlines, but the decision still requires context, weighting, and judgment. A number can put something on a shortlist for you, but it cannot sign a contract for your family. So we need to put things in context. And this is how I consider data, because they do work together. Even if the local government area, the market, the wider market is going ahead, the suburb thesis has to be right. It has to amplify the reasons why we are going into that city or local government area. And also, by the same token, the wrong street, the wrong property type, price, floor plan, tenant profile, maintenance exposure, title risk, they can still compromise a good suburb or LGA. And then overall, we might have a tick, a tick, a tick, and then across and across, and that is a no-go. We need to have cohesion, and each layer needs to amplify the next. If an advisory firm only shows you exciting properties, then it is not an advisory process. Our job is to make every property sound like it should. We need to protect the decision. We need to be realists, and we need to dig deeper until we have all of the answers. Because a typical property advisory process is no, 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 however many no's until we get to that yes, without forcing it, without compromising on a decision framework. And some people should absolutely do this themselves. But if you're busy, if this is a large financial decision, if you don't already have a team and a process and that experience, then DIY might not be free. You may pay in time, missed blind spots, those mistakes that potentially we've learnt from in the past and we don't recreate, duplicated work, weaker negotiations, uncertainty, and that emotional load that follows us through. Now, one thing that I have been noticing a lot lately, and I'm a student of the property industry and the property market. Any guarantee in this world is only as strong as the people or the business or the assumptions behind it, and it really is ringing true. So I asked 3 questions before trusting anyone with property or any type of purchase. What do they reject? What do they document, track, and improve? And where are they willing to tell you, do not buy? For me, advisory must include protections like transparency, alignment, and a process that encourages us to walk away from a deal the moment the data doesn't stack. And that might be after weeks, hours of back and forth and work. We have to walk away the moment it doesn't stack. And Duncan's asked a really good question. What are the common reasons you would tell an existing investor not to buy their next property? I can talk about it in terms of the property or overall strategy, when they would not buy another property. Property, an individual asset, there are many reasons, but I can probably give you it in numbers if you'd like. An individual property, about 10, 15, sometimes up to 20, depending on the market and the area of the time, probably around that 15% of the time when we get a building and pest inspection, we're actually going to walk away from the property based on what has been revealed to it. We're not qualified building inspectors. We don't know what to look for when we're getting under the floors or in the roof lines. We can have a pretty good look, but we're not qualified building inspectors. That is why we get the insurance policy, which is a building and pest inspection. And when we identify issues there, we determine, do we renegotiate? Do we use the leverage we've accumulated in a negotiation and negotiate, or do we walk away? Prior to that offer process, on the ground, there are a lot of things. Sometimes the data might be saying one thing, and on the ground, the feeling is different. More tangible things in the earlier stages of due diligence, public housing checks, flood checks, vacancy issues, getting the street mix incorrect with tenants and owner-occupiers. And probably a really big one for me is, it might sound abstract, but funny floor plans, not effective use of space. If the property is 200 square meters, internal size online, and the floor plan doesn't allow us to use that space effectively, then it really might only be 140 square meters, and we have to price that appropriately. Yeah, obviously, there's probably a lot of common reasons about why it's not appropriate to buy an investment property full stop for that person. Obviously, this is more of a general conversation. Definitely happy to talk to you in the Q&A at the end, and we can go through some different scenarios there if you'd like, Duncan. Hopefully that's answered your question. I'll jump ahead and we'll get to the Q&A, and I can go back and we can revisit that if you'd like, Duncan. And Colin above said that the slide is very true. I'm sorry I didn't say that at the time. So I'm not sure which exact slide that was referring to, Colin, but thank you for the comment. So what would a process look like for me if I was to sit back and, this is an optimum process? We need to understand that each layer has one job and they are related to each other. We need to reduce uncertainty and make certainty or find certainty through what I call insurance policies, rental appraisals, building and pest inspections, comparable analysis, talking to a valuer, etc., before capital is committed. And if you agree with this as an idea, then the natural question is, what process would protect a purchased decision? For me, properties are not simply discovered. They are tested. A property earns its way forward. I think of them as a business. They need to have a healthy balance sheet. They need to earn their right to be in our portfolio. And that's the way that I would consider a property investment and whether it fits into my portfolio. We don't start by asking, where should we buy? We start by determining, and this is probably coming back to your question there, Duncan. The first layer is we start by determining what we are trying to solve for. Are we looking at more cash flow, more capital growth? Might sound simplistic. Are we looking for really strong upfront growth? We don't so much mind what happens in 10 years. We just want the equity now. Or do we want a long-term stayer, above average growth over the long term? We're shifting and we're working out a growth and a cash flow profile for that property, and we are syncing it with our finance strategy. Investing today is different. We can't keep borrowing forever. We need to be very strategic with the types of properties we buy and when. And also, what type of risk are we willing to accept around that property, and how will that impact that decision making? So this is why strategy is not a formality. It is the first filter. It is a non-negotiable. Layer 2 is market logic. We look at things like population pressure, and this is a basic list, rental conditions, and I'll really summarize this in a moment: supply, affordability, infrastructure, liquidity, demographics, lifestyle demand, local constraints. But we're not looking for a single magic metric. And I'll give you an example. Population growth. If you're looking at the one number, you would go, all right, give me all the areas with really high population growth. It must be good. Well, if you think about it, for an area to grow in population, there needs to be two things: lots of people wanting to move there and lots of new homes being constructed to house them. And for me, when I hear new homes, we have to take check and we have to really think about it, because new homes are a release valve. They release demand pressure. I would much prefer a location with lower population growth, but for every one person that moves there, there's 10 people lined up wanting to move there. So we need to look at, say, something like population growth in context with other numbers. What we look for is confluence. Multiple independent signals pointing in the same direction and being cohesive. And really importantly, this is the same for shares, property, any market. Currency, it's the way that humans react with markets. Confluence, a consistent story, when it is on volume, is confirmation of a trend. Think of it, if a stock is going up in value, it's going crazy, no one's really knowing why, but the volume of that stock exchanging hands is quite low, then that trend is not confirmed. But if the price is going really strongly upwards and the volume in that stock is extremely high, then we have confirmation, and I'm far more confident to act then. I'll note that point there, Duncan, about answering that question, and we can move that over to the to the Q&A, which is not far away. So layer 3, a market can be right and the asset can still be wrong. The asset has to be financeable, rentable, maintainable, and liquid. Really important. We need to be able to have exit plans. We need to be able to make sure that that property is liquid. Not that we might want to sell it, but we need to ensure that other properties like it in the area turn over well with demand and with reliability. Because even though we might want to sell that property, if other properties like it don't turn over, then capital growth is going to be, hamstrung for quite a long time into the future. We need to make sure that that is a liquid investment and it's aligned with our broader strategy. Moving along, layer 4, a property can be a yes. This is at equilibrium. A property can be a yes at one price and a no $30,000 later. A property is only good at the right price. So due diligence, I feel for me, is not pessimism. It is a respect for risk. One of the most valuable outcomes an advisory process can create is preventing you from buying the wrong property. And that can sometimes feel like no progress, but it may be the highest value decision in the whole engagement, is the properties that we didn't buy. And I like to think of due diligence as a series of insurance policy. I keep going on about this, but it's really important. If I put a number into a spreadsheet, I want to try and find an insurance policy or a test of that assumption. Building in pest is an insurance policy against condition. Now, negotiation, I regularly, multiple times a week, have conversations or questions about, what is the secrets of negotiation? For me, good negotiation is not bravado. It is preparation, it's evidence, it's timing and restraint. And really importantly, it's not about, this magical lowball, okay? When we have done the due diligence to identify a property and it has ticked all of our boxes, okay, we might need to realize that that due diligence process is a point of competitive advantage. We want to construct a negotiation that is a win for us and a win for the vendor without either of us losing. We want to get a good deal, but sometimes if the vendor loses, that may be a smokescreen with something that we have missed in due diligence. It might be a red flag for us. So we would like to be very detailed and comprehensive in our due diligence and then negotiate for a win-win, a good deal and an environment where we can proceed with confidence. Now, what do these properties look like? Because they all look very similar. So this property here was an example that we looked at and we moved on from. It's the type of property that creates false confidence. This client was set on a low maintenance brick investment. And this property ticked a lot of boxes. Once on the ground, it was clear that the comparable properties we would use to assess value and to construct the deal were actually superior. Right in this pocket, public housing was impacting the owner-occupier appeal. And we had to reassess the numbers. We had to then reassess the comparables we'd use to justify value and walk away. And that was after spending a lot of time on the deal. And that's a good process. Sometimes it can feel like no progress, but avoiding, once I mentioned before, avoiding a bad purchase can be one of the highest value outcomes of an advisory process. We don't just say no. That's not a good process. We might say no quickly, and when something survives, we can say yes with confidence. So this is a very similar property, and this is one that we actually said yes to, and we proceeded through that process. Now, there are subtle differences with this property. The numbers have to be confirmed through each layer of due diligence. The insurance policies have to check out. They're not just protecting our downside, they are confirming what we had previously assumed. Negotiation, if we are not able to achieve, the line in the sand that we would walk away from, we have to walk away. And a property has to survive a due diligence process. And when you do this en masse, you can generate for the right properties at the moment in the right markets, very strong purchase entry points compared to comparables and very strong yields. And the best part for me is that, over time, interest rates go up and down, but let's just say they go up and down. They are over time, pretty stagnate. They might go up to 6 or 7, they might go down to 3 or 4, but they generally average out. Where over time, rents compound. So even if a property is purchased now and it's slightly negative geared, we might not get the tax benefit on that purchase anymore with the budget changes. A property that has very strong rental growth very quickly moves into cash flow positive territory. And then the longer that you hold it, the stronger that gap is between rent and interest rates, interest repayments, and it moves further and further into cash flow positive territory. And that's the secret. It was an aha moment for me when I read Jan Summers' book when I was about 17 about property investment, and that's when it really clicked for me. So, what Ripehouse has built, we are research first, advice without the sales pitch. And I pride myself on a team that stays with the client beyond the purchase. It is critical for me to build meaningful relationships across a wealth journey. It's not about a purchase. It is about how we structure purchases from one to the next. And in between becomes meaningful focus on client welfare, wealth results, wealth generation, and true friends with a common interest, which is property and wealth, which is a nice outcome. For me, it is data, judgment, and execution, and they all have to work together. If we work together, then it's not just a call and then a random property. It is a sequence of decisions, and each one is designed to reduce uncertainty. The process is designed to slow down the dangerous decisions and speed up the safe ones. And for me, fit really matters. I've got another poll here really quickly, guys. Once again, doing two things at once. I would love to hear your feedback on how you are, any questions, how you are perceiving, the framework and how I'm talking about things. Where are you after seeing this framework? I plan to buy and would like help applying it. I'm planning to buy, but still deciding my approach. Awesome. I'm researching for later. I love due diligence. I love preparation. Well done. And I'm comfortable doing it myself. Awesome. I'll let those answers come in really quickly because for me, it's not just about who a structured private advisory process works for. It's also about who it might not be a fit for. Because it's for those of you that want to buy an investment property with discipline, not pressure. It's for those of you who have or can arrange finance capacity and are interested in a finance structure and strategy, not just a deal that sort of gets you into a box that you can't break out of. And that you're also prepared to act if the right opportunity appears. That's very important. It's for those of you that value evidence, due diligence, and professional judgment, and that understand that good advisory sometimes is being told, not this property. So the answers to the poll are 40% of you are planning to buy but still deciding on my approach. Wonderful. 29% of you are planning to buy and would like help applying it. Wonderful. The same number of you are researching for later. And then 3%, I'm comfortable doing it myself. 2%, sorry, it's gone up to 6% now. Guys, this is the strength of this conversation, I feel, because we all have different priorities. We all have different things that we would like to do and different ways of going about it. And that's to be encouraged. So awesome work. I've got that. We've got the answers there. We've gone through the process. I have a link here that I've just dropped into. It's a pop-up there on the left-hand bottom of the screen. And the pop-up says, review my position. Because would it be useful to have this framework applied to your own position? For those of you that are saying yes, I've opened, as you can see there with the review my position button, an investor decision review. You don't need to wait until the end. I'd love it if you did. And I'm here for any Q&A, ask me anything at that time. If you would already know that you would like us to look at your position, there's no obligation. It's a 15-minute conversation to begin with. It's also to work out both ways. Is there fit, and is it worth continuing in conversation? So you can book that while we're talking. Otherwise, stay with me regardless, because I wanted to show you what this looks like in practice. Now, this is not just a lot of dots. We take tracking, measuring, and improving very seriously. My wife thinks I'm a little bit of a nerd. Sometimes that's a good thing, because each dot here is a client portfolio that we have worked with that client over the last 5 years. And it's looking back from today. So it's a 5-year rolling number. Each dot is a client portfolio, shows when they purchased it and the compounding annual growth rate for that portfolio since the first purchase. So just so you know, the long-term average national compounding growth rate is actually 6 to 7%. Over the last 5 years rolling, nearly 1,400 purchases, we've averaged 17.1% compounding annual growth rate. So each property compounding, growing 17.1% each year on top of each other. Think about that for a second, because that's almost 3 times higher than the national average. And this is an historical observed performance. It's not a forecast. It's not a guarantee. It's what's happened in the past. And I don't show you this to suggest every property, every portfolio performs in this way. I show it because I'm going to claim to have a disciplined process where we measure the outcomes of the process. And I think that's the key. We measure the outcomes and improve based on those measurements. We own that. And this is because of the decision quality. We're protecting the downside risk. It's as simple as that. So there are really only 2 ways forward from what I've shown you today. You can build this process yourself. And for some people, I genuinely, obviously with some of the questions and the poll answers tonight, I genuinely think that that's the right answer for some of you. And that's awesome. And if you're planning to invest over the next, right now up to the next 3 to 12 months, then you jump in. We've got the review my position button there. You can arrange, if you'd like us to even have a conversation with an experienced wealth advisor with that no obligation to apply the process, look at your position. It's not another property pitch. It's a genuine offer of a mutual conversation. So jumping to the Q&A in a moment, guys. You've been very patient. 7:40. I do thank you for your time. Once again, we have opened the no-cost 15-minute investor decision reviews. If you've got your desktop out, it might be easy for you to click on the QR code there with your phone. In these sessions, we look at where you're trying to get to, what's currently standing between you and a good property purchase, and what I think your next step should be in consultation with the team. And very importantly, it's absolutely critical. If we don't think Ripehouse is the right fit for you, we'll tell you, and we can suggest alternatives. So once again, that button's down there. It will open up another tab. You can choose a time that works in the calendar and then come back in a moment. We'll start the Q&A. The point of this conversation, this webinar, wasn't to convince you to buy something. Absolutely not. It was to help you make better decisions. If you would like us to apply that thinking to your decision-making process, then that's what the review is for. So if that's where you'd like it to leave it tonight, I really do, from the bottom of my heart, thank you for your time. I'm now here as long as, to go through, answer any questions, ask me anything. Nothing is off the table. I'm an open book. But once again, I do thank you for really prioritizing your investment future, how you consider property investment. It's a wonderful vehicle to use to get ahead in Australia, and it will always continue to be because they're not making any more land. It's as simple as that. And people need a roof over their heads, and us helping them to do that through providing rental properties is something that should be encouraged and rewarded. So with that in mind, thank you guys for attending. Q&A now. Linda, best decision going with you guys. Great growth in my Adelaide property. Awesome work, Linda. I don't have your last name there, so I do apologise and sorry if I didn't recognise it. Daniel has asked a couple of questions. I'm just reading the second one first, so I'll come back up to the top. Casey, no worries. Chat soon. I might scroll up, so keep those messages coming through, guys. I'm just aware of, I don't want to jump into a question at the bottom and then someone who's been very patiently waiting has been missed. So I'll just roll up. Duncan, what are the most common reasons you would tell an investor not to buy their next property? And I think I answered that. You mentioned, I think I might have just answered another question I was about to ask. How do you balance rental yield, cash flow, long-term capital growth when borrowing capacity is a constraint? So probably to answer both questions, the reasons why I would tell an existing investor not to buy their next property is if it's going to effectively be the last property that you purchase. And I've seen this a lot with investors over the years. They're a bull at the gates. They buy an investment property and it basically locks them into that position for, at least a 10-year period. They've hit limits. They can't buy again. They would have to sell and then realize capital gains, which would, not be the best outcome for them. Each property that you purchase has to break open a strategy or a portfolio, or at least achieve what you're trying to achieve with that portfolio, whether that's, accumulating equity, harvesting capital gains, harvesting cash flow. So probably to answer your question at a really high level, we can definitely go into this in more details with the review my position conversation. Look, Miles and Ian in those conversations are very experienced property people and qualified property investment advisors. And, if your situation is complex enough, then Chris Allen is a very close associate in more, structured financial planning and advice with advanced structures attached to it. And then also Mark Davis, Lewis Johns, some of the other guys over at ALIC, Heath is another one, Tash, top tier in terms of finance strategies. They're the guys that go to when I've got a problem in my portfolio. How do I keep scaling? What do I do? Then we are having a three-way conversation, a four-way conversation. And I think that's how it needs to be. Each person is holding each other to account. Collins mentioned 1 week versus a life of disappointment. Look, in some cases, I get comfort from going through a process. I get comfort from looking at the properties that I reject or reject for others. That gives me comfort to make decisions. And if you go through that process, you're ruling out a lot of those risk factors. Let's try and avoid that life of disappointment. That's the goal. So Gotham, first question. I'm not confident to purchase now because the net gain after selling the property in the future is reduced a lot because of the removal of the 50% capital gains discount. Fair call. Second question, are there properties available with positive cash flow day one, given that negative gearing cannot be tax claimed? So 2 questions, and they're great questions. And look, I would hazard a guess that a lot of you on the line still who've stuck around have exactly those 2 questions. So when I first started buying investment properties, finance, I can still remember when my broker called me, he sounded very somber and he said, Jacob, I've got some bad news. I'm not going to be able to get you 100% LVR anymore, right? It sounds crazy, but just think about that for a moment, because all you needed to pay was the stamp duty, the buying costs, and you could buy a house. So, you could go out, you could get something with really high cash flow, high yield, and you could effectively just keep buying one after another. And there were some situations where we saw a really great property, we would put the stamp duty on a credit card. Not that I'd recommend to do this. We would do a renovation on it, on the credit card, would have a refinance, pull the equity, pay the credit cards off because it was that good a deal, we'll buy again. And we would do that every month. That was the type of environment that we're in. if you're buying really strong assets that have good, strong, positive cash flow, why would you ever sell them? And that's how I used to live. Well, why you wouldn't sell them was because you could keep financing more deals. So there was no opportunity cost from holding it. Now, in this environment, in this world, there is opportunity cost because you have debt service ratios, you have LVR restraints, you have, far more constraints there in the finance world. So there is, a cap on what you can buy. So there definitely is more emphasis on selling down those assets if they've gone through a very strong growth cycle. And there are other assets out there that you could potentially purchase to reignite, an upswing, another growth cycle. But then, as you say, the CGT discount was removed, so the costs of selling are far higher. For me, it goes back to holding properties, holding quality assets for longer, if not forever, and then looking at ways of maximizing cash flow from those assets. So this is probably answering your second question. Remember, even if you buy an asset today that's negatively geared and you have very strong rental growth, very quickly it will be cash flow positive. There are properties out there that are pretty high cash flow, up to sort of 5.5%, 6% yield. We're not compromising things in terms of capital growth. For me, it has to be first and foremost capital growth. You can go out and you can get your higher yields, but it's not really going to grow in value very strongly. Okay, but then we were looking for rental growth, high capital growth, high rental growth. So very quickly they come into cash flow positive territory. And then the other thing is, one thing that we're looking at and we've been working with clients recently is the addition of granny flats. Whether you're buying a property specifically to add a granny flat, or you are adding a granny flat to a property that you already own, it's great because then that is increasing the overall cash flow from that property, increasing your serviceability to be able to continue buying properties. And then it's also, because that is such a strong cash flow producer, giving you less reasons to want to sell that in the future. Some of the sort of numbers, it does vary. I've seen between $170,000 and $250,000, depending on size, specification, location, for a granny flat. And then you're expecting between, $450 to $600 a week in rent. So say $220,000 is giving you $480 a week in rent. So extremely high. I don't have my mental calculator on me, but 12 or 13% yield on that investment. It brings an overall property into very firmly cash flow positive territory. It keeps you buying, and it gives you less reasons to sell that property or that combination. So, there's probably another advanced conversation out of this, Gotham, and definitely have it with Miles or Ian. But then I would be looking at moving cash flow into commercial properties, equity into commercial properties, into self-managed super funds. Is not financial advice. It's it's just options. Definitely, we can talk through it with a qualified advisor, and then we are able to look at selling down, refinancing, etc. So it is an ongoing conversation, but there definitely are solutions. Nigel, how does this metric work with properties you source for external buyers agents? So then there's just a correction. How does this metric work with properties you source for external buyers agents? So I'm probably just, if you're on the line there, Nigel, if you could probably just clarify that question a little bit there. Are we talking about Ripehouse Advisory? There are a couple of buyers agents. I have been called, I guess it's a little bit corny again, the buyer's agent's buyer's agent. There are a few buyer's agents out there. At one point, it was over 70 buyer's agents that I was actually researching and sourcing properties for and putting my tick of approval on for them. There are a few still, but it hasn't been a focus of my business since COVID, if that answers your question. Showan, when do you think the market will recover? At the time being, the property prices are going down due to all the new good, strong owner-occupier-led market with very low vacancies and very strong cash flow. Okay, Nishant, how are you? For an investor whose main goal is building equity while keeping out-of-pocket holding costs low to pay off primary home loan faster, how does the portfolio fit stage decide between buying one 700K property versus two 500K yielding properties? Look, let's go through these numbers individually, Nishant, and you're probably not going to get off the top of my head. Remember, the number one goal here is capital growth. Capital growth unlocks things for us in the future. Okay, you're not going to get a huge variance there if you don't compromise that capital growth between 500K and 700K. You'll probably get a lot of difference between a $400,000 asset and 700K, but or 350, and the particular type of property might be higher maintenance, poorer condition, but you'd still rent it out for the same amount because people are desperate for properties in that area. So it comes with higher risk profiles. I would probably prefer to look at, say, a $500,000 property and a $200,000 granny flat, which would essentially give you the two 500K property rents, believe it or not. So, we've seen $200,000 granny flats renting for almost the same as a property on the front. Hopefully that answers your question there, sir. Duncan, if an investor already has a 4-property portfolio, well done, is looking to add another property, how do you determine whether the next property genuinely improves their portfolio rather than simply adding another asset? And at what point would you stop accumulating residential property and start considering commercial or other asset classes? Definitely have a chat to us about it, Duncan. We're buying commercial properties at the moment for clients from $500,000 up. Growth and yield definitely do vary to residential. Also, it's nothing changed in terms of buying commercial in self-managed super funds. It's something I've just done for myself. Definitely worth probably talking through a few of those options if you haven't already booked a review session. Simon, I'm interested in commercial. How are you there? Long time no speak. How do you see commercial performing in the next few years versus residential? So I've engaged within the business, hired head of acquisitions for commercial. He has a $30 million personal commercial property portfolio, extremely experienced, worked for over 20 years in financial markets and data science and private wealth, and owns all of his properties, that $30 million in commercial. He's an absolute pick of the bunch. Sorry, mind the pun. He's a guru. He really suits my methodology. I recently purchased a $2.5 million commercial property on the same thesis in my own name. And for me, it is using the same Ripehouse, R-score, the same data and due diligence on the front end to find the locations. But we're able to embrace those locations. I sort of touched on it before. In the Ripehouse world, we're not so much driven by population growth because we might have unmet demand. In commercial, we are embracing those areas with really strong population growth, lots of new homes, because that means people are actually moving there in more numbers, and then there are more people to be the customers of the businesses that are your tenants. So we also need to do financial and business analysis on prospective tenants. Commercial property that I purchased was owned by a 90-year-old from Mildura. It's a property down here in Hobart. It was extremely under-rented. When I say that, there was 2 of the 4 tenancies were vacant. 2 of them were extremely under-rented, to the point that one of them was a local artist that I think lived up there and was paying $11,000 a year for absolute prime view waterfront Hobart commercial. And then the 2 retails at the bottom were okay, but I'm sort of looking at it going, hang on, one of them is on the corner, the busiest premium foot traffic in Hobart, on the corner there of Davies Street, Macquarie and Murray, St David's Cathedral, Treasury on the other building, Law Society on the other corner. You've got a little haberdashery shop in there paying $40,000 a year in rent when it could be a boutique wine bar or speakeasy type bar paying $120,000 because the zoning and everything is okay. We've now had a bridal shop. They manufacture dresses, move in on the upstairs. They've now got a fitting rooms and all of that beautiful wood paneling space that they've fitted out. We've now got a lawyer moving in on the top level, and obviously we've moved into one of the offices. We've completely overhauled the rental profiles of this property. I'm doing a lot of talking, guys, but the reason why I say that is we get an area where the businesses that rent our properties are going to be doing better in the future. There's lots more people moving to the area. We buy in areas where we manufacture growth through increasing the quality of the tenants and the rental yield, and then also selectively choosing them that will be improving the property, which is then improving the asset. And so when you can do that, it's a long-term process. It's not a conversation where it's like set and forget, guys, thank you very much. Talk to you later. We strategize, we look through the books, we look at the market, we look at opportunity within the area. For me, my property that we just bought is about 800 meters from where the new AFL stadium has been built. And in my research, there were 200 professionals to be hired by that AFL team on $150,000 or above. Physios, marketing, HR, all of these things, they need this premium office space. So we do the research about the businesses and the opportunity, and then we are actively working with you and the property manager to increase the tenant mix over the long term. And that might be a 5-year plan. The outcomes and the benefit are amazing in terms of, I'm sort of not exaggerating, but we can go in the property that I purchased to 2.5 million. You're increasing, the purchase price was based on it being under rented and the rental amount and the open tenancies. By filling it out, increasing the rents, we're looking at almost a 1.5 times, so 150% capital growth in under 12 months. And that's the sort of revaluations that have come back to us now that we've got the property rented out. And I'm talking, well, that's $4 million in profit. I'm not saying that to brag in any way. It is possible when you do that due diligence and research. There are other opportunities at a smaller scale, and as mentioned, $500,000 and over, or $480,000 the other day was a deal that we were looking at in commercial. So look, they do grow actively in value, but we've got to control those variables. I don't think it should be at the expense of residential. Probably the optimum for me is buying commercial in self-managed super funds. I would use residential to increase equity, increase cash flow in our personal names, then do concessional contributions into your super fund and build that up and buy commercial there. And then I'll be holding those in the correct structures to be passed down. That's probably how I would think about it. Doing a lot of talking, guys, so I'm so sorry. Hopefully that answers your question, Simon. Nick, I have a question. What do you think about the trend of buying a newly built property? I'm not a massive fan of buying established properties, not because new tax changes, but it is thinking risk side mainly and some other issues it entails. Look, we all have our personal preferences. For me, we've done a lot of research on new properties. Generally, when you're looking at a marketing company or, there's a lot of big name buyers agents. I won't name them here, but you're probably aware that do look at new homes. They're effectively being paid by the builder. And the moment that you walk out, pick up the keys, it's no longer new. That premium evaporates. Your buying pool to rent or sell that property evaporates because it's generally surrounded by lots of other new homes, and no one would dream about buying a secondhand or renting a secondhand dwelling if there are new homes still to be built around it, because they'll just get one of those. For me, we've done a lot of research on this, and look, it has to be probably updated. The research is about 3 years old now, but it would be pretty similar, where at the time, new properties across 5 years of capital growth across many tens of thousands of sold samples, and we were only measuring properties that had sold twice in a 5-year period. So we were very, it might have been sold new for 500. It might have been sold secondhand 3 years later for 520. We only measured the capital growth for those properties that had sold twice in a 5-year period and that were new, and they actually grew in value at 1/3 the rate of inflation. So across many tens of thousands of new homes that sold twice in a 5-year period, they were performing at 1/3 the rate of inflation, about 1% capital growth. We see that time and time again. Sure, tax advantages, all of those wonderful things. Tax, whether I pay it or not, is not a reason for me to invest. I would like returns. You can have your cake and eat it too. And we have employed this strategy very actively over the years. We're buying a newer type property, 5 years old, still wonderful depreciation, but it's been built out. You have low maintenance. You have a good quality of tenant in an area, but you don't have that, new car driving out of the park, the car yard loss. Tracy, do you only look at houses as an investment? 100% houses. Look, if the short-term cycle through affordability is favouring apartments, then that's a short-term cycle. For me, we want large land components with houses. Land appreciates, buildings depreciate. It's a cliche, but a lot of our clients that we purchased with, say, 4 years ago on 600 square metre blocks, and they are now putting granny flats on those properties as almost a bonus. $180,000, $200,000 are giving them $450 to $500 a week in rent. You can't add another apartment on your balcony, if that makes sense. So I've not been cheeky, but Berges, if someone owns a fair bit of property in one state, would you say it's better not to buy another one there and instead pay down home loan or invest elsewhere? We're definitely nationwide buyers agents and property advisors. For us, we apply the same strategy and formula, and as time goes on, it shifts its way across the country. So when you follow the same strategy, you're naturally diversifying. Plus, in today's educated buyer pool, why would anyone invest in so-called new builds? Look, everyone has different preferences. It's I'm looking at personally building a new home at the moment, and constructing it. We subdivided a block, we're building on it. Look, it's probably going to make, fingers crossed, a reasonable amount of money, but it is a lot of effort. I wouldn't go through the process of buying a new build and negatively gearing. For me, a tax benefit is not a reason to invest. Look, the upside, the strong growth and yield you can achieve when you are not trying to chase that tax benefit far outweigh the tax benefit. If I had, the absolute strongest capital growth strategy at my disposal, just saying hypothetically, I would hazard a guess that would provide more upside than this, a tax benefit on a substandard investment. So, look, it's for me, it has to work, right? It's about not just a purchase. It needs to be an ongoing conversation and relationship based on successful purchases that do what it says on the box, and then just keep doing the same boring thing over and over again, because it works. So Tech Song, talking about cycles, how do we know when the cycles start based on what data? Example, Queensland, WA just done their cycle. Everyone says Victoria. Which way do we determine that? So think of it probably more on a local government area level, Tech Song, and how I think of it, probably, I can go into a really nerdy data direction, but I'll maybe tell it as a bit of a story, because humans, we generally go towards areas in packs and for similar reasons. It might be new employment, it might be warmer weather, the weather is getting warmer. It might be train lines, it might be, new hospitals, bigger hospitals, new education. Drawing people there. A hospital is a really good one and probably the strongest driver that we follow. But a new hospital has been built. People need to go there to work. Older retirees need to move to the area to be closer to it, as an example. It's increasing the demand for people to live in that area. They generally will rent first to try it out, to test it out. That might be a 6-month lease, a 12-month lease. They look at each other and go, this is really working out. We love the area, let's buy. And then they start going through that rent to buy cycle. The key here is the rent to buy transition. So we're tracking a rental market, changes in the rental market. Really importantly, we are seeing and tracking a transition to the buy side, and we're looking at certain signals in those situations. And then we are seeing that buy side momentum really start to resulting in a coiling up of the market. And it's a very consistent progression that we see time and time again. And we know when we see that coiling up of the market, that we can then position ourselves there. We're not waiting for the growth. We're not waiting for other people to start talking about it. We are refining that same pattern on our own data, on our own analysis, and moving in there. And the really great thing about that is that people have pushed the rents up in the area because they've all piled in there and they're moving to the buy side. So we generally have high yields, high rents at that point for that area, and good capital growth fundamentals. Hopefully that answers your question there. Nikhil, top 3 factors impacting our score significantly: days of supply, rental vacancy, and rental growth. Not in that order. But I'm not trying to hide anything. I just didn't say it in the right order. Frank, if we're buying with an exit in mind, we focus on making the property appealing to owner-occupiers. Absolutely. Granny flat may improve cash flow at exit. It could appeal to more investors and owner-occupiers willing to pay the top dollar. It's a really good conversation. If you are looking at selling that front property, then maybe a granny flat will limit your buying pool. If you get the area and the demographics right, it might actually increase the buying pool. You know, the property that I'm sitting in now, we have a granny flat out the back. We've never had a granny in it, but it's great to have friends and family come over and stay. We definitely paid a premium for this property because it's literally got, you know, my son's 14 now, and soon he'll be out there living in the coach house. So yeah, maybe we can look at it in a few different ways. An owner-occupier, if it's the right type of property and the right demographic, they might see it as a positive because they wouldn't rent it out. They'll just keep it for themselves, even Airbnb'd it. So it's probably not as simple as a black and white, but it could definitely be part of a buying brief, and we would make that consideration on each property that we would look at. Duncan, how would you assess whether adding another regional Victorian property makes sense? Look, if you're spread across Vic, Queensland, WA, you're already reasonably diversified. There's some great opportunities in New South Wales and Tasmania at the moment. It might be worth just, you know, looking at those states to continue the diversification. Diego, how are you, sir? Ripehouse, my favorite partner. Last house I bought with you more than doubled in value, and rent also went up, which I think's probably more important in the long term, that good, strong rental growth. Just not in an optimum place to do the next step right now. Well, look, we're here for you, sir. It's an ongoing conversation. If you ever need any advice, strategy, the chess pieces, let's talk. Tracy, have to go. Not a problem at all. Was interested in thought in the areas and a lot of development and infrastructure being built around Bankstown. Look, Sydney for us as a market, there are lots of pushes and pulls. We're not seeing the confidence in the apartment market, that's for sure. We're not willing to change our buying rules for that market. Look, there's a lot of opportunity that's far more blue chip at the moment across the country. When you have the nation as your buying pool, then you know you don't want to constrain yourself. Look, I'm getting through this, guys. So Texon has a question there about how to compare markets if there are no recent sold in the area. That's probably a reason not to be buying in the area in the first place. Because remember how I sort of spoke about how markets transition. One of the signals that we're looking for is increased sales volume and reliable sample size, so all the data makes sense, but increased sales volume and a very buoyant and active sales, buy side of the market, and it's transitioned from a rental side. Excuse me. Last question here from Casey. As a foreign buyer, how do you cash out equity to repatriate? Or does one have to buy the next property in Oz? Is the fruit of these investments to cash flow over time only? Is the fruit of these investments to enjoy cash flow over time only? Look, it's a good question, and it's probably I'm not delegating to a review my position conversation, Casey, but there's a few strategies that you can access equity without selling, and then moving that into commercial or other types of assets. Obviously we want to avoid capital gains tax with the discounting, etc., where we can. But I think from, this is just my opinion. It might be wrong, probably be wrong, but I think as a expatriate, your capital gains tax is actually lower than us as a resident of Australia. There was something that I read the other day that it was a 15% capital gains tax for foreign buyers in Australia, which surprised me. So we definitely need to fact check that. But look, it might be a conversation with myself and Miles and Chris Allen, who's a very experienced financial planner, and he deals with structures all day and moving chess pieces around to work out what we're actually wanting to achieve from this property. Anyway, guys, look forward to it. Yes, I do as well, Casey. Look, we can really sort of balance what we're trying to achieve with the rule book. I guess I categorize 2026 as the rules of the game have changed, but the game hasn't changed, right? I still think property is a very strong way to develop wealth. Remember shares, crypto, business, they've all been hit by the same changes to CGT. Not negative gearing, obviously, but I never focused on negative gearing at all in my portfolio. And for the properties we generally buy with clients. Remember, we buy for capital growth, and the fastest we can get to positive cash flow, the better. So hopefully that all makes sense, guys. I love your questions. Really, genuinely, it's a lot of thoughts. We're owning this process. We're methodically working through things, and that's to be commended. So the recording will be come out. Share it with friends and family. We're here to help, and I'd love any thoughts and feedback. Talk to you all soon.